All right, segment 3, using your mortgage as a financial tool. All right, next. Okay, so improving monthly cash flow to have more money at the end of the month, paying off student loans, reducing loan term 30-year to 15-year, reverse mortgages, or purchasing an investment property. Let's go ahead and start out with improving monthly cash flow. All right, so this is what I feel is the biggest way to use your mortgage as a tool. And this is for loans that once you have a house and you're refinancing, this is a way that you can use it as a tool. Is you can pay down or pay off all of your credit cards. Credit cards now, if you miss a payment, you'll go from a 3 or 5% credit card all the way up to 28%, just like that. Okay. And sometimes people get in financial trouble and they miss a payment and their credit cards can go so high. And so then there's paying off your car, paying off installment loans. It spreads it over a longer term, but puts you in more control of when it's paid off. So let me give you an example. We have a single mom. A single mom has kids at home and is just barely making it. She utilizes her credit cards to be able to stay afloat, has a car payment, has furniture payments, it's tight. Money is tight. Well, if you can utilize refinancing that debt into your mortgage and spreading it over a longer period of time, you could, at the end of the month, and when I mean cash flow, it's money that you have left over at the end of the month. In this case right here, it very easily, a person could have $500 more at the end of the month. Granted, it's spread over a longer term, but to have $500 when your kids are young could mean the difference between buying groceries or not. It could mean the difference in being able to send your kid to private school, to be able to pay for a babysitter. It could be, a very integral part of your financial situation. But I would use caution in utilizing this for your monthly cash flow. And what that is that if you know yourself and you're the type of person that if you paid off all your credit cards, you'd go right back in and fill up those credit cards again, that's something you probably don't want to do, because you'll start using your home as a cookie jar, and whittling away all of the equity in your home and then putting you in a more leveraged position with a higher payment. And so you have to be careful. And if you're a person that, would do that, you just want to be real careful with that. Let's go ahead and move to the next. Okay, paying off student loans. All right, student loans generally run around 7% interest rate. By refinancing these, you could cut that rate in half. Okay, so you're seeing the rates that we showed. We were under 3% on all of those. Okay, and sometimes rates are at 3.25%, 3.5%, or 4%. But even so, you could cut your interest rate in half, which is a really big deal. And something that I don't know that a lot of people get when they're getting student loans is when a student loan is deferred, you're still paying the interest. It's only the payment that's deferred. It's not the interest. So you're still paying that interest, even if it's deferred until you get out of college, that money is still being charged. So you want to pay this thing off as soon as humanly possible. It might feel good that it's deferred, but you're still paying interest on it, and that interest is accumulating on you. Let's go to the next slide. All right, reducing your term. All right, now this is something that not everybody can do, but if you can, or I'll discuss of ways of doing it that can really be hugely beneficial for you. So reducing your term. So let's go ahead and say you went from a 30-year to a 15-year fixed. I went ahead and broke down some numbers for you so you could take a look at just how beneficial this is. And then I'll show you a little shortcut that you can use that I think will save you tens of thousands of dollars, even if you can't adhere to a very strict 15-year payment. Okay, so on a 30-year fixed loan, a $400,000 loan at 3.25%, the payment is $1,740. At 360 loans is how many payments it takes to pay off a 30-year mortgage. You're paying $626,697 to pay back that $400,000 over the term of the loan. On a 15-year loan for $400,000, the rate is better for a 15-year than it is a 30-year. So at 2.5%, you're paying $2,667.15. At 180 payments, that's 480,000. So if you look at that, if you paid a 15-year instead of a 30-year, you're looking at saving $146,000 over the life of the loan. $146,000. That is so huge. That is just a really big amount. But let me go ahead and talk about ways that you can shorten the term and save tens of thousands of dollars. Now, one way is some people will do a biweekly payment. A biweekly payment, basically what that does is that gets you, since there's 52 weeks in a year and not just 4 weeks a month, if you make a biweekly payment, it pays an extra payment a month. I'm sorry, an extra payment a year. So in doing so, what happens is this, it breaks it down, depending upon the interest rate, it'll break it down to somewhere 20 to 25 years. So you'll cut about 5 to 7 years usually off of your loan if you make an extra payment per year. But take a look at this. And this is just like we talked about $5,000 for closing costs is kind of a baseline that you can use. You can also say this, if you pay time and a half on a 30-year loan, it just about equates a 15-year. Okay, so let's go ahead and say that you really can't commit to making a payment of $26.67, but you can commit to making that $17.40 payment. All right, so if you were to just go ahead and add half of that $17.40, it adds up to just over $2,600. Okay, and so you could be making a 15-year payment for the times that you can, and then if you can't, just pay what extra that you can. The one great thing about an amortized loan is it will automatically amortize into a lower amount of years. And as that decreases, as that amortization decreases, you start paying more principal and less interest as the loan progresses. All right. So you want to pay these things off as soon as you possibly can. And one other piece to a 15-year loan, and that I think is so attractive, is that when you get a 30-year loan, it's hard to fathom paying something for 30 years. It's a long time. It's a lot to swallow. But when you get a 15-year loan, boy, you have every intention of paying that thing off. I think you're getting aggressive with it. And it's some hardship to make that extra payment. It is, but the rewards are huge if you can buckle down and get it done. Next. Reverse mortgages. All righty, reverse mortgages are only for borrowers over 62. Now, with reverse mortgages, they got kind of a bad reputation for a while there. What was happening is people that were elderly were getting taken advantage of. They were having a smooth talker come in and get them into a mortgage that maybe might not have been a very beneficial loan for them. And so what happened is the government came in and FHA started regulating it. So what they do is they have mandatory counseling to make sure that anyone over 62 that's going to do a reverse mortgage has the mental capacity to be able to do so. All right. So there's absolutely a place for reverse mortgages for our older members that and alumni that really has a place. So the things that you can accomplish by this. You can eliminate your mortgage payment, taxes, and insurance for the rest of your life and never have to move out of your home. That's a big deal, especially if you're getting closer to retirement and you're thinking, man, if I could only pay this house off, I could retire. Well, you could do a reverse mortgage and maybe eliminate that payment and be able to retire earlier. It's certainly something to consider. Also, it gives the borrower access to some of their equity that they no longer qualify for. And let me say what that means. So when a person retires and as they get elderly and they stop working, they don't have that income coming in anymore. And so with that said, remember that acronym that we had, debt to income ratio and ability to repay. So generally when somebody retires, a lot of times they don't have enough money to be able to qualify for that mortgage anymore. And so by doing a reverse mortgage, it makes it to where they can actually get a loan and access some of the equity in their property and not have to make a payment. And so let me give you an example of a reverse mortgage we did. We did a reverse mortgage for just a really sweet lady. She was 81 years old. She was living off of Social Security only, and she had $300,000 worth of equity in her home, but she couldn't access any of it because she couldn't qualify for a loan. And so she went ahead and gave us a call, and we were talking to her about it. And what it ended up being is that we could go ahead and make it to where she didn't have to make any more payments. We were also able to impound her taxes and insurance for the rest of her life. So she didn't have to pay a mortgage, taxes, or insurance. Okay. And with the equity, we were able to give her at when the loan closed, she got a $50,000 line that she could spend any way she wanted. And then after 1 year, she got another $40,000 that she was able to spend on anything she wanted. So she was able to acquire $90,000 worth of the equity of her home, get rid of her payment, and get rid of the taxes and insurance for the rest of her life. And she still had Social Security coming in and being able to use that Social Security for whatever she wanted. That was a big deal. That's life-changing. And when you see situations like that where you can help somebody out, it's just wow. It's a great feeling to be able to do that. And one of the things in one of the misconceptions about reverse mortgages they had, that I think people had, or the public had too, is that lenders would get you into this and they just wait for you to die, and if you died early, they grab your home. And it's just not the case. A reverse mortgage is based with an interest rate just like any other mortgage. And for each payment for each payment that would go by, a little piece, which would be your mortgage payment. Say there was a $900 payment on $100,000 worth of loan that was there. That $1,000 would come off of the protective equity on it, and whatever was left. So if she died the next year, her heirs could go ahead and sell that house. They could refinance that house and still have all the equity that was in the property. So it's certainly protected. So we love to talk to the people over 62 of maybe being able to help them out, maybe help them retire early. Let's check the next one out. All right, purchase an investment property. This is really exciting stuff as well, because in California, we're so blessed in that the values just keep going up. Granted, we've seen some crashes. In 2008, it was pretty bad. But if purchasing investment property with the equity out of your house is something that a lot of people do. It can be done. It can be a very smart thing to do, but this is not for everyone, and it's something you have to utilize extreme caution with. Okay, because if a market turns or a life event happens, you need to make sure that you have enough reserves or enough backing to be able to weather that storm. I mean, think of the pandemic. We just went through a time where, the state of California said people don't have to pay the rent, and if you're not prepared, if you don't have the backing for something like that, you can get yourself in some trouble. So you want to be well capitalized if you do that, and you want to have people around you or counsel around you to be able to help you make that good decision. Some of the things you want to look for is you want to look for making sure that the property can rent and it'll cover your mortgage payment. That's a great way to take a look at it. You certainly don't want to be in the negative for any period of time, because if a life event happens, you could get stuck, and that foreclosure would ruin your credit, or a short sale, or many other things. All righty, let's go to the next slide. All right, so question number 5. What are unexpected expenses to look out for that could affect your payment on a purchase? All righty, let's go to the next slide. Okay, HOA dues, homeowners association dues. Now, again, when you look at getting a house payment, you think of, your payment, your principal, interest, taxes, and insurance, and you're good. Not exactly. There's a couple of things that could come into play. And so when you're looking at houses, you want to ask the question. If you have a good realtor, chances are your realtor will let you know that, hey, that homeowners association dues are this. And another question, because those homeowners association dues, I mean, they can be $100, but that's not real common. Generally, there were between $200 and $600. Most commonly, I would say around $300 for homeowners association. Now, that's for a planned development. It's usually in condos or townhomes where you have or gated communities. You'll see these a lot, and so you need to make sure that on top of your homeowners, your loan payment, your taxes and insurance, that you can afford to pay that as well. And then there's Mel Roos. Mel Roos is something where you would want to ask the question if it's a pretty new development. So if a new development, like if it's under 15 years old, I would absolutely ask the question. Or if it's, if it looks new, ask, are there Mel Roos on this? And how Mel Roos come out is they don't come out as just like a payment. What happens is they add it into your tax rate. Okay. And what it is, it's there to be able to pay for infrastructure, schools, parks, etc., to be able to develop the area after that neighborhood has been built. Now, Mel Roos, to give you a kind of a feel for where they usually end up, they usually end up about time and a half. So if your tax rate is at 1.25, heck, it could go up to 1.8. Okay. And so like on a $500,000 loan, your taxes are about $6,000 per year, equaling $500 a month. That $6,000 per year could go up to $9,000 with Mel Roos. So in LA, there's not a whole bunch of neighborhoods that are Mel Roos, but you know what? Out in LA, there certainly are on the outskirts of LA. There's new development still, and in those new developments, you might have that happen. All righty, let's go to the next question. Question number 6. Does Cal State LA FCU do loans in Nevada and Georgia? Answer. The reason why I didn't just come up with Nevada and Georgia, those were 2 questions that were on our list for the attendees that signed up. So at this time, Cal State LA FCU is only doing mortgages in the great state of California. So let's go ahead to our next segment.